Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling lesson 9 of the fixed assets module. Victor, please walk us through.
Thank you, Bob, for the introduction, and welcome to this lesson in our Financials Functional Training series. We are still on our FA setup, and we are still looking at book controls, which we started about 2 sessions ago. So just to remind ourselves, this is what we need to do. We have done the first 2 steps. We are in the middle of doing the book controls, and remember I said that once we are done with all the book controls, we have basically created our corporate book. Okay, so once we enter the calendars, the accounting rules, and the natural accounts, then we have created our corporate book. That is what we are in the middle of doing. So let me take you to that page again, just so that we are used to it and we keep track of what we are doing. So let me go to Fixed Assets Manager, Setup. Book controls. So this is what we're talking about. We have talked about what we need to enter in this field. There's still something to be said about the ledger, but we are going to come to that. We've talked about the depreciation calendar, prorate calendar, and all that. There's this other tab for accounting rules and the natural accounts. So in this session, we are going to deal with the natural accounts. The reason why we can't go to this tab is because we haven't specified a ledger, and I believe I had demonstrated this to you. So if we put in a ledger here, we can select this tab now. So we are going to talk about these accounts. This group here contains accounts that deal with retirement of assets, and down here deals with accounts that are concerned with deferred depreciation. Okay. So what we aim to learn from this session, we are going to understand the concept of gain and loss. As you can see, we have this gain, loss, and clearing here. We are going to talk about what that means. And we are going to understand some of the accounting in FA that concerns itself with asset addition and asset retirement. We are going to first do an overview so that we can, by the end of all our lessons on the accounting, we can understand the purpose of all these accounts here that we need to specify. Now, there's one other thing that I need to mention. Even as we deal with this book controls. Now, as you have seen, we need to specify a ledger there so that we can go to that natural accounts tab. So what I wanted to say is concerning the ledger, in order to use your corporate book, you have to specify that ledger where the accounting entries will be sent. Okay. So in order to use that ledger with FA, that ledger has to have a cost center segment. Okay, so that is a requirement for using a ledger with your FA applications. Okay, you need to have a cost center segment in your ledger. All right. So when we are creating our corporate book, when it gets to the time where we go and fill out all those fields for the calendar, the accounting rules, and the natural accounts, we'll have to specify a cost center segment in our chart of accounts for our Maskani ledger, which we aim to link to this corporate book. Okay, so I just wanted to mention that, and it's something that we are going to do when we go and fill out our book controls. So anyway, as I said, these are the natural accounts that we need to have there. So we are going to look at a bit of FA accounting, and it's going to help us understand the purpose of these accounts. Okay. So before we start, what I would like to say is that the accounting that is created that involves these asset transactions will involve different modules. Okay. For example, asset acquisition, you will have to pay for that asset, right? And that will be handled through payables. Okay, so there'll have to be some accounting from payables, even though we are dealing with assets. Okay. Let's say you want to retire an asset and you're selling it. Okay, maybe it's a vehicle, it has outlived its useful life to your particular client and they want to sell it. So once they sell that, they are going to receive some money, right? That is a transaction that will be handled through receivables. Okay, so the accounting, the transactions will involve different modules, and we are going to see what role each module plays. But first, we are going to understand the accounting in its final form. What do I mean? Not per module, but the overall accounting that involves these asset transactions, such as acquisition and retirement. And then after we understand the accounting as a whole, then we will go and look at what accounting is created from each module, then piece it together and come back to where we started with the accounting as a whole for all the modules. Okay, so this is what we are doing in this session. And remember, we are going to also understand the concept of gain and loss. So let's start with accounting for asset acquisition and depreciation. So when you acquire an asset, this is the final accounting that's created. Okay, you're adding an asset to your books and you're paying cash for it, right? Now, like I said, it doesn't happen in all that one transaction like that. There are other accounts involved, maybe some liability accounts, some clearing accounts. But now this is what I mean by we are looking at the accounting as in its final form. So you're adding an asset. To add an asset, you debit, right? The account is asset cost, okay? And finally, you're going to pay for that asset and you're going to credit your cash account. So this is the accounting that's created for asset addition as a whole. What about depreciation? So for example, let's say you acquired this asset in January and placed it in service in January, and then you said according to your convention you want to start calculating depreciation expense from the following month. So this is the depreciation entry that would be created as an example, depending on whatever methods are being used. So depreciation expense is an expense account And accumulated depreciation, we talked about it and we said it's a contra asset account, okay? So its natural balance is a credit balance, which is negative. And that's the opposite of what an asset account should be. That's why it's called a contra asset account. So this is how depreciation would be calculated periodically. This is for February and this is for March. Okay. Now let's go to asset retirement. Okay. When you are retiring an asset, what does it mean? It means you're removing that asset from your books, right? That asset maybe has outlived its useful life, so it's being maybe trashed, or it is going to be sold, so it's going to get off your books either way, or it has been damaged, so it's going to be disposed, or it has been stolen, so it's off your books either way, okay? So asset retirement means we are removing the asset from our books. So it means we are reversing whatever transaction we did, not reversing, the account which we hit when we were adding the asset, we are going to remove the asset now, okay? That account was asset cost. So you debited when you are adding, so you credit the same value because you're removing this asset from your books, okay? To balance this transaction, you debit the accumulated depreciation, which is a contra asset account. So it has been accumulating a credit balance from these depreciation entries. You can see accumulated depreciation 5 for March, it's going to be 5 for April, if that's what the method dictates. So if this asset is completely used and it's retired at the end of its life, it's completely depreciated, the accumulated depreciation will be equal to the asset cost, right? Different sides of transaction, but equal numerical value, okay? Remember, depreciation is just expensing out this cost over a period of time. So it's like we are removing that amount from here and adding it bit by bit to this balance here, okay? However, this asset cost account will only be hit at retirement. So over the life of the asset, the asset cost account, which is basically the value of the asset when you purchased it, will remain the same. These are the accounts that are going to be hit, the depreciation expense and the accumulated depreciation. But when it's being retired now is when you you credit the asset cost. And remember, we've said that asset cost minus accumulated depreciation is equals to book value. So this is a simple retirement whereby the asset has been fully depreciated. We can assume this asset is just going to be disposed or maybe abandoned somewhere, so there are no costs at all associated with this retirement. We can have retirement happening with what we call book value loss. And what that means is that that asset has not been fully depreciated when it's being retired. Okay. So for example, let's say your vehicle is stolen before it has been retired and you don't recover it. Okay. So before it has been fully depreciated, sorry. So it's stolen before it's fully depreciated. So you have to retire it, remove it off your books because you're not going to recover that vehicle. But you have incurred what we are calling a book value loss. Why? You paid 100 for this vehicle, let's assume, but you only got to use $80 of it, right? So there's a $20 somewhere which you didn't get to use because you didn't use it up to the end of its useful life. So that's a book value loss. And that affects this account, the gain loss account, which can be created as a revenue or an expense account. Okay? So if it's a revenue account, which I want us to assume in our case, I actually just forgot to indicate here. So if we are debiting revenue, it means we are reducing revenue. So that's a loss, right? If we create it as an expense account and we debit, then it means we're increasing our expenses, which is also, you can see it as a loss, right? So this is asset retirement with book value loss. Before the asset has been fully depreciated, you're forced to retire it. And this is what the accounting would look like. And in this case, the gain or loss is equals to book value. In this case, because it's a loss, it's the negative of the book value, right? The book value, remember we said, is asset cost minus accumulated depreciation. So asset cost minus accumulated depreciation is 20, which gives you your gain or loss. In this case, we have said it's a loss because we didn't expense out the whole cost of the asset. Now, the other way you can retire an asset is by selling it, okay? So if we look at the first journal entry, the asset has been fully depreciated. Straight away, you should know that accumulated depreciation and asset cost should be equal in that case, right? The value, not they're on different sides of the transaction. So if you retire this asset by selling it, it means you're getting some money, okay? Now remember, this is the part where we say that part of the transaction will have to be handled by AR because it's a receivables side of it's a sales ledger side of sales ledger transaction. So you're selling your asset and getting some money for it, okay? But remember, we said that we are looking at the accounting in its total form, finality, when you cancel out all the accounts, if I put it that way. So in the end, you will get paid for your asset that you sell, and you'll get paid in cash, right? So proceeds of sale or cash proceeds, sort of written here, should have written proceeds of sale for uniformity. We are trying to learn about those accounts that we saw there in the book controls. But this is that's what this refers to. So you got cash. When you increase cash, you debit because it's an asset. Of course, you're retiring the asset. Okay, so you credit the asset cost. And you will have a gain of $20. Why? Because of this proceeds in cash. So in this case, the gain or loss is going to be equal to the proceeds that you get from selling your asset. Okay. What about if your asset was only partially depreciated? So accumulated depreciation in this case is 80. This letters in brackets, by the way, represent the type of account. So this contra asset, asset, revenue. Okay. So in this case, accumulated depreciation was only 80. You would not expect out the remaining 20 of book value. But then you decided to sell this asset anyway. Okay. In this case, you sold it for $30. All right. Maybe because it was newer than this one, which is fully depreciated. You're retiring it, so you're taking it off your books anyway, so you have to credit this full asset cost. So what is your gain? In this case, your gain is $10. It's a gain, so it's a revenue account, so we are crediting it. You are crediting it, so that's a gain. And your gain here is equals to proceeds of sale minus book value. Book value was 20 because you had not depreciated the full amount. So 100 minus 80 is 20. Then 30 minus 20 to get your gain. That's the same thing we did here. Book gain or loss is going to be equal to the proceeds. All right, it's going to be equal to the proceeds minus the book value. Book value in this case is 0 because it's fully depreciated. So the gain becomes $20. Now let's look at retiring an asset by selling it, and with that asset having a cost of removal. Okay. So what is it? Like what example can we give? Maybe it's a lab or something, and that asset needs some specialized skills or some special skills to handle it. All right, so you hire people to come and remove that asset and dispose of it, so you have to pay them. So that's the cost of removal. Okay, but after you remove it, you're going ahead to sell that asset. So that's what we are looking at here. In the first case, the asset is fully depreciated. Okay. So accumulated depreciation is 100, which is equal to the asset cost. You're going to sell this asset for $30. All right. So your cash is going to increase by $30. You're going to pay to remove this asset $10. This is the final accounting in terms of that payment, right? Because you're going to make a payment and credit your cash account, reduce your cash. So that's why we are saying that this is cash, because actually that's the final. This is the final accounting. You're going to reduce your cash because you're paying for this service. So you sold it for 30. You got 30, and then you had to pay 10 for it to be removed. So your gain is proceeds from selling it, proceeds of sale, minus cost of removal, which is 20. Okay. And the final accounting created is like this balances 130 on this side and 130 on this side. In the second case, the asset has not been fully depreciated. All right. So accumulated depreciation is 90. So we are incurring a book value loss of $10. Okay, because 100 minus 90 is 10. So there's a 10 which we did not use, which we did not expense out. But you're retiring the asset, so the whole amount has to come off your books, so you credit the asset cost. And you're also paying for this asset to be removed, which is $10. So your gain or loss this time round will be 30, which is proceeds of cash, minus the book value loss, which is 100 minus 90, minus the cost of removal. So 30 minus 10 minus 10. 30 minus 20 is 10. Okay. So we have looked at where these accounts come into play. The cost of removal, proceeds of sale. Okay. So we understand what role they play in the accounting, or when they would be affected, okay, or involved. But we have looked at this in an overall form, like the overall accounting when you sum up the transactions from AP, from acquisition of the asset to addition in FA, and if it's going to be retired, and if it's going to be sold. So we have looked at the final transactions combining all those parts. So from there now, we are going to go and look at the individual steps of those transactions and the actual lines that are created involving the different modules. So for like acquisition, we know it has to involve AP. So there's going to be a liability line somewhere. There's going to be some clearing accounts. But we wanted to have an overview first of what the whole process looks like. And we have also understood the concept of gain and loss, and how gain and loss can come from various things such as proceeds of sale, okay, cost of removal, all right, and book value loss. And we all now that is going to help us understand why we had those gain and loss fields under the natural accounts when we looked at that window in Oracle. So that's what we wanted to understand for this session. So Bob, unless you have something to add, we can stop this session there. Hello, Bob.
All right. Thank you, Victor.
All right.